Hello and welcome to Jazz After Dark. We're financial advisors here at Jazz Wealth. And sorry, I'm in a goofy mood. We're working on like a weird commercial that we can do, and well, because we have the cameras and such, we're gonna do it here, or not in here, but at the office. So we were just kind of goofing around with that. Also, I got a little bit ahead of you guys. Got an old fashioned here. Going fancy tonight. You can make fun of me if you want. Now we're still using the Russell's Reserve that I got up in Kentucky. Interestingly, I'll be back in Kentucky probably next weekend, if not the weekend after that. So if anybody wants to hang out in old Lexington, we'll pick a place, see if we can get together. Um, should be hopefully next weekend. But it's fancy tonight because I went with the Rose Sage Bitters. Hmm? At the wife's suggestion. I can't. It sounds fancy. I can't taste it. I don't smell it. I don't know. It's an old fashioned, right? So that's all I can tell you. Hey, in the spirit of being picky and a little bit tough on you guys, I felt bad about the other day. I was being a little bit tough and frustrated. And I said, well, I'm still frustrated, but about something different this time. But there's room for education, process, efficiency, way for you to fix this. Notice how as we grow, I use bigger words. I got Doug here in the back office. So Doug, if you ever come by, Doug runs the show. It's my business, but he runs the show, and I pay him well to make sure I don't have to do all that boring stuff. And so he's put up on the walls, everybody's birthday and the Florida employee rights and all of that. Whereas before it was just like me and my mom and Cody, and we would just, whatever. So I've been using words like efficiency and process, which, that's not a big word, but it is for me. Anyways, you very likely are someone who places a trade every now and then. It's fun stuff. Nowadays with your phone, you put a trade in there, you see what happens, you have a little fun. However, if you're more than that, if you're hoping to make some money and actually consistently make some money, you have to track yourself a little bit, right? It's called trade tracking. There's some software that does okay out there, but if you can't measure your money management, you will never be profitable. I'm sorry. And we've done a class for clients where I actually went through exactly how to do it. I'll give you a little bit of that tonight, actually, because I was looking through emails. You know the emails I get. I was looking through emails and I'm like, somehow we got away from that. And it's really important. You don't start a business and not have a budget, not at least have some resemblance of what you're going to spend your money on and what income you have coming in. So in the trading world, let's get right to it. We can go two ways. You have some flexibility. But you must track yourself. You got to know how successful or not your strategy is, your stock that you like to trade, the time of day that you like to buy something, maybe the time of the month that you like to buy something. Do you buy at the beginning of the month if there's an earnings play? Do you only buy stocks that gap up? Do you only buy stocks that immediately reverse yesterday's action? Do you only buy stocks that are severely extended? There's something that wets your whistle and causes you to buy a stock. I'm one of those guys. I like when a stock sells off a little bit and then just kind of rolls away, and it gets like overextended. So that's my thing. When I see that, I get excited. I don't get excited about breakouts. I don't get excited about, earnings triple plays, as they call them, three peats, as I've been calling them, where they beat on earnings, revenue, and raise their guidance as well. But if you have a strategy, we've got to track it. Now, if you bought a strategy or you work with a trading group or something or an investment club or something like that, well, they have a strategy and you've hopefully learned from them. It's time to measure it. How successful is that? You do that with your 401k, right? Take a peek, see how it's doing. You do that with your IRA. Is it keeping up with the market? Do you want it to? Things like that. So there's two ways you can do this. Number one is more of the investor side. So if you're one who buys and, you check in every now and then, but when you find that a stock has done something, it causes you to want to add it to a little small portfolio. And, if it takes 5 weeks or, a couple months or something to make a profit, you're happy with that. Well, you would focus on a percentage-based risk. In other words, you might say, I'm going to take 2% of my account value, those dollars. So for example, if you had a $100,000 account, you'd say, well, I'm a guy that likes to have 15, 20 positions on, or a girl that likes to have 30, 40 positions on. What I'm going to do is take 2% of my account, and I'm going to take those dollars, in this case, $2,000, and I will buy however many shares that requires me to buy to spend $2,000. Thankfully, there's fractional shares. And you will give yourself a range, also in percentages. Very common for people to just say 8 or 10%. So in other words, you would buy $2,000 worth of stock and you say, I'll tell you what, if it falls 8, 9, 10%, something there, just make it consistent. I'll admit defeat and I'll get out of my way. That's fine. And then you set profit targets. If it goes up 8 or 9, 10%, I'd like to know about it, but maybe I'm not going to sell. I think that over a couple months or something, or a year, this thing has greater potential. Now that's for what you would call mid to long-term investor. That's how you look at that. If you're anything shorter than that, where you say, Dustin, I don't care if I make money tomorrow or next week or next month, whenever it happens, I'm happy with that. If it falls the day after I buy it and it's beyond, a reasonable risk, I don't want anything to do with it. Okay, so you're in a different camp. You're going to use what's known as risk-based measurement, risk-based trading. I don't know, risk-based, whatever you want to call it. And what you're doing is you're saying there's a set dollar amount that I'm willing to risk. I'll use $100, and I'll show you an example in a second. I will risk $100. So now you've got a little math to do. So you would say, I'm willing to risk $100, and the stock that I'm buying happens to cost $10 per share. I don't know how many cases there is of that anymore, but because it's late and I've got an old fashioned here, we're going to say it's $10 a share. So now you've got a risk of 100 and a stock price that's $10. Before you can do anything, you need to know how many shares you're going to buy. That's the risk part. So we want to size the position so that when you happen to hit your loss point, you lose $100 right at that moment, not a penny more or less. So you look at the stock and say, well, my strategy says that I will buy a stock, and $10 stocks aren't very volatile, so I will give it a $1 range. So in that case, now we can do the math. We could say I'm willing to risk 100. The stock is $10. If a $10 stock falls to $9, I want to lose $100 right at that moment. So if you buy 100 shares, and the stock goes from 10 to 9, you lost $1 per share or $100, right? So you would do that. Now, if you can imagine, if your window from where you want to buy it to where you'll admit that you're wrong is 50 cents, okay, well, now you can double that, right? You can go 200 shares. 50 cents loss times 200 is $100. Notice how in each one of those scenarios, I didn't start talking about the profit first. So if you don't know, my background is, as of before Jazz, was in fund management. I built mutual funds for clients that were overseas, and we did all of that for them that they couldn't do it here in the States. And before that, I taught Chinese investors and people from Israel and Singapore how to trade the markets. They wanted to gamble. And so I would literally trade right in front of them, but it was on the computer. It'd be their dinner time was our market. And they would follow along, and we would buy and sell throughout the day and do what we did. Notice how I didn't talk about gains, because gains are the easy part. You didn't learn anything by gaining on a trade. In fact, I would argue that it's a bad habit. If you buy a stock that you think is going to go up and it goes up, you go, ha, it went up. Yay. Like nothing happened. But if you buy a stock and it goes down, oh, now we got to focus. What's the game plan? Have you fallen into this? Tell me in the comments. Have you fallen into I have. I'll just admit this, numerous times. You buy a stock, it's not going down, right? But inevitably it goes down. And so then it falls and you're like, yeah, I'm down $1 a share or whatever. Now I'm down $2 a share. Then some news comes out, you're down $5 a share. And you're like, that's way more than I wanted to lose. That's your fault. You never defined what you were willing to lose in the beginning. The winners take care of themselves. That's the easy part of the money management. The losing side is where you have to focus. That's where this will determine whether you make a profit or not. So I got a little geeky with this. I'm going to just pop on over here. Don't let this alarm you, and please don't email me a million times for this. Just a simple spreadsheet that over the years has gotten more complicated. We are breaking down this in a few categories. You don't have to be as crazy, but we've essentially said we're going to log some trades down here. And just as they happen, we're going to put them in, and we want some information. Now, you could simply say maybe the date, the ticker symbol, whether you were long or short, and then you could just put in here whether it was a winner, a loser, and how many shares you had and what you paid. Because sometimes you might buy a couple times, and then you can just tell this column to answer this column here, right? So we're going to enter these trades over time, and we want to know up here at the top, we want to know our success rate. Because believe it or not, we don't have to get more than half the trades right. It's certainly helpful if you do, but you can get 1/3. Did you know that, by the way? Did you know that you can get 1/3 of your trades or investments right and still make a profit? That's not an opinion, that's pure math. But it's only if you limit your loss, if you define that from the beginning. So in this case, we're pretending that this person here is what's known as a risk trader. They're going to define their loss. In other words, when we lose, we want to lose, over here, we want to lose $100. We do not want to lose any more. We will position ourselves in such a way to where if it falls beyond our stop price, we will lose $100. Oh, sorry, you couldn't see it. It's down here. It's a rather big sheet. And so this part is just a stats-driven thing. Now, there's software that does this, but back in the day, we didn't have the software, so I built a spreadsheet. So we say, well, what is this trade? Is it my play? Was I involved with some news article or something? Was this an automated system? Did I set up a scanner? These are things where you could say, well, my plays suck, but the scanner is doing really well, so I want to follow that. Was it a winner, a loser, or a scratch? Was it long or short? You can get crazy and say, what time of day did I go ahead and buy that? And then over to the right, all we've done is say, was it a particular strategy? And you could just name it whatever and give it a thing. That's all. I'm just trying to give you an outline of what to use. Here's what ends up happening. I've entered a few trades just to show you. On this day, at this time, so this was an earlier in the morning play. And believe it or not, these times are important. And from my own doing, I just put the M up here, so it was my own idea. I bought AMD, and I was long, and the play type was just a basic pullback, meaning I just saw the stock going up, it pulled back, and I believed it would then continue to go higher. Right? It could be anything in here. I just put a symbol. And I had used the daily chart to make that decision. In other words, this was not a day trade. This was something where I said, as the days went on, the stock was going up. Then it came back down, and I said, well, that can't be the end. It must want to still go up. And I'm pretending that I bought it there, and something happened, right? So let's see what happened after that. So the result of that was a winner for $25, and ultimately I bought 100 shares, I sold 100 shares. Bought them at $33.75, sold them at $34. The date's kind of irrelevant. At a different time, long bought, was a $100 winner, bought at $33, sold at $34. Down here we have a loser. Later in the day, apparently on the same day, same stock, bought it, and it was a loser. I bought 50 shares at $34 and lost them at, sold them for a loss at $32. Notice how it's $2. I bought at $34, was willing to let it go to $32. 50 shares times $2 is an even $100 loser. Now, if you go to the top, for this effort, whatever, I haven't done a lot, but for this effort, it resulted in a $25 profit. I got 2/3 of them correct, which we can see down at the bottom there. And the winners relative to the size of my losers were 0.63. We call it your batting average and your win-loss ratio. In other words, how successful were you on just a straight analog kind of a thing? Win-loss, win-loss, win. What it was a win or loser. How many times did you win or lose? If you won twice, lost twice, your batting average is 50%. However, if you won twice, but the times that you won $200, and you lost twice, and the times that you lost 100 apiece, right? You'd have 200 and 200 over here is 400, and then you'd have $100 loss, $100 loss. Huh. That means you have a $200 profit, but you were only as good as flipping a coin. You see how that is? Like people say, I could pick a stock. Doesn't really matter if you can pick a stock. That's great. If you could pick one that's going to go up, what do you do with it when it goes up? What do you do with it when it inevitably wiggles lower first and then goes up and you're hopefully right on your trade? That's the trick. The whole name of the game is money management. And so as a risk-based trader, you're willing to lose 100. You know that you can't buy a stock and sell it when you're up $100 profit. You must have to have the belief that the stock will gain $100 profit for you, plus maybe another 100 and another 100. If you can find those types of things that you're into where you say, I don't know if it's going to go up right here, but if it does, I've seen those go up quite a bit. And so if I risk 100 and buy here and put my stop loss here or whatever, but I know that the reward is 2 or 3 times more, well, now I just have to measure how accurate my eyeball is. Was I right in my assumption that when I see a stock that does this, it tends to go up many multiples of what it would go down? That's the strategy. That's what you do. And you're not going to get this right on the first try, but you right now think you see something that's going to go up and it goes down, and then you're stuck and you say, well, I'll just hold it. You go on to another trade. You go, oh, crap, that one didn't work. Well, I guess I'll just hold it till it comes back. What a horribly inefficient use of your dollars. And every one of us have limited usage of our dollars. Even Warren Buffett himself has a limit to the capital that he has. So you've got to get through this mindset of, I'm buying a stock because I think it will go up tomorrow after earnings. And then it goes down. And you say, well, it's a good stock. I like the prospects and stuff. You changed your mind. You totally went down the path of, hey, you got a new CEO coming in and my buddy's all into it and stuff. No, whereas before you said, I think their earnings are going to be good. It's going to go up. You've done that. Come on. You've done that. Where now you go down this path of the shoes that they sell are, nice. And I saw the neighbor down the street and he's got them. You're fooling yourself. You're using the most explicit, the worst explicative, is that the word? That you can use in the market. You can say every bad word you want and it will not affect me. It will not affect the markets. But the minute you say hope, I get goosebumps, right? That's a trigger word. You've seen the kids that say that stuff. You don't say hope in the stock market. But inevitably you buy a stock and it starts going down and you're like, well, a little bit more. I'll hang on and hope that it goes higher. Gotcha. You said hope. You're going to lose. It's just the way the world works. I don't know what to tell you. So the moral of the story, track yourself, limit. You can have whatever loss you want. You have big dollars and you want to risk $1,000 a trade or 20%, or you want to say, instead of risking 2% of my account, I'm risking 10. I never have more than so many positions. Okay. I wouldn't, but you go ahead. Maybe you have more money than I do. I don't know. The size is irrelevant. The fact that you're consistent is what's relevant. Because now, if given enough time, right here. So if given enough time, I have this B. Oh, I'm sorry, you can't see it. So I'm going to go like this a little bit. So I've got this B here. And in my simulation, I said, well, this play was a basic pullback play. Now, you would assume that I've defined that. I've come up with some rules as to what a basic pullback buy position is. And so I want to know if that strategy works. I can easily now come over here now this is not enough data. You get where I'm going with this, but I can come over here and say my buy pullback, basic pullback buy, I had 2 winners, I had 1 loser. Times it by 300. So, okay, well, I had 600 winners after some period of time, and I had 300 losers. Okay, can I live with that? Well, it turns out I made 125. My average gain was 63. How do I slide over? Like this. There you go. And now I can say, well, this strategy is somewhat successful right there. I seem to be winning more than I'm losing, but I'm not winning much more than I'm losing. So would I continue this? Yeah, but now that there's no commissions or anything, I guess there's no real cost to making a small profit. But ultimately, this is a little off. I like the success rate, but I don't like the win-loss ratio. So now knowing that kind of data, now it allows me to go, okay, I like the strategy. It's obviously close. Am I getting out too soon? Should I maybe wait just a little bit longer before I buy it? Maybe my entry's a little bit off. Maybe I take profits too soon, and I should go back and study those plays and see, did it ultimately go a little higher? Was it better on days where the market was higher, or was it better on days where the market was lower? I bet you it was the first. Would I be better off if when I did the basic pullback buy strategy, would I be better off if the sector that it's in this case technology, was having a strong day? Or would I be better off, is this stock moving on its own a little bit more? In other words, if the tech sector's up and I notice AMD's up and it pulls back for a minute, okay, I want to buy that one. I've got the strength of the sector. Maybe the market needs to be up as well, and the stock can be up. So see how I'm putting all that together going, maybe I refine my rules a little bit. I have no freaking clue how to refine my rules if I don't remember all of these trades, if I don't log them in some way, if I don't see the data. So we're past, last thing I'm going to say, we are past the gift of the year 2021, right? Go back all through the last decade. You would have these pockets of years where you couldn't do any wrong. And they'll come again, but it's not happening this year. Remember the days where you could just buy something and it would go up? Throw a dart, guess, right? Do whatever you want. It was going to go up eventually. Well, those are gifts. They happen every now and then. They're not happening this year. They certainly didn't happen last year. So we've now got to be a little bit more strict about our rules. It's kind of like if you own a business. Let's say you're selling umbrellas and you're selling them like hotcakes, man. Oh my God, it's been raining forever. Well, the rain's going to stop and you're going to have to become more strategic about selling umbrellas. Or you're selling umbrellas like hotcake and somebody next to you goes, geez, you're doing great there. I'm going to sell umbrellas too. And now you've got to get a little bit more strategic to make sure you're selling more umbrellas. Trading is the same thing. So at the end of the day, it comes down to money management, risk management, then target management. See what I'm saying? The targets will happen. You didn't do anything like strategically. You didn't do anything smart by buying a stock and selling it for a higher price. You did nothing and you learned nothing. You learn from the risk. You learn from the losses, especially if you're tracking them. All right, rambled on a little bit too much there for you, but I get fired up about this stuff. And hopefully it makes you think a little bit more. Just what can I do to be more efficient? I do want to be more specific. Have at it. Enjoy. If you're a client, you can go back and actually watch the description of this in the dojo. And you can also see how we define the risk. Like if you're 30% successful, but you're making 1.2 times what you're risking, is that good? And we go through all of them for you there. But anyways, occasionally we do talk about this kind of stuff. It's helpful. I know it helps you guys out there, and hopefully you liked it. Give me a thumbs up and be honest. Let's see the comments below. Have you ever bought a stock and told yourself, well, it went down, but I'm gonna wait. I'll see what happens. You've done it. Don't start. You will.